Well, there is one thing happening in the market right now that most people are reading completely backwards. People see stocks going up, gold holding strong, silver refusing to disappear, and they immediately think, okay, maybe the economy is healthier than everyone expected. But what if that is not the message at all? What if markets are not celebrating strength? What if they are simply reacting to the quiet destruction of currency purchasing power? So in this video, we are going to separate the real signal from the noise. We are going to talk about money supply, inflation, sovereign debt, central banks, gold, silver, energy risk, and why the old investment playbook that worked for decades may be breaking right in front of us. And by the end of this, you are going to understand why silver investors are watching this moment very, very closely. And if this content gives you value, subscribe to the channel and drop a quick "Our John AG" in the comments so the algorithm knows this community is paying attention to real financial analysis, not just noise. Now, the surface level story is simple. Markets are rising. People look at their brokerage accounts and feel better. Maybe the panic was overdone. Maybe the bad news was already priced in. Maybe inflation is finally under control. Maybe central banks have everything handled. But wait a minute. At the exact same time, households are still getting squeezed. Food is expensive. Rent is painful. Insurance is brutal. Energy prices can change the entire monthly budget for a working family. And when someone earning low wages has to pay high fuel prices, that is not just an inconvenience. That can be the difference between staying current and falling behind. So how can both things be true? How can asset prices rise while ordinary people feel poorer? This is where the money supply argument comes in. When more money is pushed into the system, that money does not hit everybody equally. It does not land in the pocket of the average worker at the same time that it lands in financial markets. It often moves first through governments, banks, credit channels, institutions, and asset markets. So before it improves anyone's daily life, it can lift the price of assets. And that is the key point. Rising markets do not always mean rising prosperity. Sometimes they mean the measuring stick is shrinking. Think of it like this. Imagine you own a house and the price of that house doubles. On paper, you feel richer. But then groceries, taxes, insurance, repairs, energy, and everything else also jump. Are you really richer? Or is the currency simply buying less than it used to? That is the question most investors avoid because the answer is uncomfortable. Now, people love to argue about inflation statistics. Some say the official number is too low. Others say the methodology is fine. But the more useful way to look at it is this. Inflation is not experienced equally. The official Consumer Price Index is designed to measure average changes in prices paid by urban consumers for a market basket of goods and services. But your real-life inflation depends on what you personally buy. A family spending most of its income on rent, food, utilities, and gasoline can feel a much harder inflation shock than someone with a bigger income and more flexible spending. And that is why inflation is so dangerous. It does not hit like a flat tax. It hits the people with the least flexibility first. If you make a strong income, higher gasoline might annoy you. If you are barely getting by, it can crush you. If your rent jumps, your grocery bill jumps, and your energy bill jumps, you do not care what the headline number says. Your personal inflation rate is already screaming. So when you hear someone say, inflation is cooling, the next question should be, cooling for whom? Now let's move to gold and silver, because this is where a lot of people get confused. Every time there is a crisis, some investors expect gold to explode immediately. If it does not jump that week, they say gold is broken. If silver hesitates, they say silver is useless, manipulated, or dead. But that is not how monetary assets usually work. Gold and silver do not always move when impatient traders demand it. They often move in bursts. Nothing happens. Nothing happens. Nothing happens. And then suddenly, the market reprices years of monetary damage in a short period of time. That is why judging gold or silver on a daily chart can be a massive mistake. It is like watching a pressure cooker and saying nothing is happening because the lid is not blown off yet. The pressure can build quietly for a long time. Then, when the release finally comes, everyone acts surprised. So the right question is not, why did silver not explode this morning? The right question is, what conditions are building underneath the market? And those conditions are not small. You have governments running massive debts. You have central banks trying to protect credibility. You have households fighting living costs. You have investors questioning whether bonds still provide the safety they used to provide. You have energy shocks that can appear suddenly. And you have currencies that depend heavily on trust. That brings us to the most important risk in this entire story. Sovereign debt. This is not the flashy part. It is not as exciting as silver squeezing higher or gold breaking records. But sovereign debt is the foundation under the whole system. Government bonds are treated like safe assets. Banks hold them. Pension funds hold them. Insurance companies hold them. Retirees hold them. Governments depend on them. So what happens if investors start demanding much higher yields to compensate for inflation, deficits, and currency risk? That is where things get serious. Bond prices and yields move in opposite directions. If yields rise sharply, bond prices fall. And if government bonds fall too far too fast, the pain does not stay in one corner of the market. It moves through banks, funds, mortgages, corporate borrowing, government budgets, and eventually the real economy. This is why central banks are in such a difficult position. If they raise rates aggressively, they can hurt jobs, investment, housing, and growth. But if they keep policy too loose while inflation pressure remains, they risk damaging purchasing power even further. So people say, why don't central banks just fix it? Okay, fix what exactly? If inflation is being driven by excess demand, higher rates can cool demand. But if inflation is being pushed by energy disruptions, shipping stress, fertilizer costs, supply chain pressure, or geopolitical risk, higher rates do not magically create oil, diesel, jet fuel, or fertilizer. A farmer does not stop needing fertilizer because a central banker gives a speech. Airlines do not stop needing fuel because rates move higher. Truckers do not stop needing diesel because a committee changes a policy statement. That is the trap. Central banks can influence money and credit. They cannot print barrels of oil. They cannot print copper. They cannot print wheat. They cannot print trust. And that is why the phrase, central banks are collapsing, should not be understood as a building falling down tomorrow morning. The real collapse is in their room to maneuver. They are boxed in. Raise rates too much, and something breaks. Cut too early, and inflation psychology can come back. Hold still, and markets start guessing what the next mistake will be. This is the part nobody should ignore. Now, energy risk matters because the world economy is still physical. We can talk about artificial intelligence, apps, cloud software, and digital platforms all day long, but goods still move through ships, trucks, ports, pipelines, and refineries. If a major choke point gets disrupted, the impact can show up in fuel prices, shipping costs, and inflation expectations. The United States is stronger on energy than it used to be. Official data shows the U.S. remains a major crude producer, and in 2025 it exported more crude oil and petroleum products than it imported. But that does not mean the U.S. is completely immune from global energy shocks. And it definitely does not mean Europe or other importing regions are protected in the same way. The world oil market is connected. A shock in one place can become a price problem everywhere. This is why inflation can reappear even when people think the story is finished. And that brings us back to the traditional portfolio. For decades, investors were told the simple model was stocks and bonds. Stocks for growth, bonds for safety. The famous version was 60% stocks and 40% bonds. Simple, clean, easy. But what happens when bonds no longer behave like clean protection? What happens when inflation hurts bonds and stocks at the same time? What happens when government debt itself becomes part of the risk? That is why more investors are rethinking the old structure. Not because every bond is worthless, not because every stock is dangerous, but because the old assumption that bonds automatically protect you in every crisis has been badly damaged. So where does that leave the average investor? Not with panic. Panic is not a strategy. It leaves you with selectivity. You want to understand what you own. You want exposure to productive assets, but not blindly. You want to think about businesses that can survive inflation, pass through costs, protect margins, and keep demand even when the economy slows. You also want to be careful with highly cyclical sectors, when energy prices, credit stress, and consumer weakness are all sitting on the table. Banks, airlines, and automotive companies can be incredible at the right price and at the right time, but in a fragile macro environment, they can also carry very specific risks. Banks are sensitive to rates, credit quality, and bond portfolios. Airlines are sensitive to fuel and consumer demand. Automotive is sensitive to financing costs, employment, and household confidence. So the message is not, never touch them. The message is, do not pretend the cycle does not matter. And then there is gold and silver. Gold is the cleaner monetary hedge. It has thousands of years of history, deep central bank relevance, and a very clear role as a reserve asset. Silver is different. Silver has the monetary side, but it also has an industrial side. That makes it more volatile, more frustrating, and potentially more explosive when the setup lines up. Silver investors know this already. Silver can test your patience like almost nothing else. It can go sideways when it should move. It can pull back when the story looks bullish. It can make people doubt the thesis right before the move becomes obvious. But here's the question. If currencies keep losing purchasing power, if debt keeps rising, if central banks remain trapped, and if investors slowly lose confidence in the old 60-40 model, where does capital look next? That is not a guarantee. That is not a promise. That is a setup. And setups matter. If you have had success protecting your savings, building a metals position, buying at the right time, or simply staying disciplined while everyone else panicked, share that in the comments. People need to hear from real investors who are actually doing the work, because that can lift the morale of others who are trying to make better decisions. Now let's be very clear. This is not a call to go all in. That is how people get hurt. Markets can stay irrational longer than you expect. Silver can be volatile, gold can correct, stocks can keep rising even when the economy looks weak. Bonds can rally even when debt looks scary. But risk is not the same thing as opportunity. The smart investor is not asking, what do I want to happen? The smart investor is asking, what is the system forcing people to do? If governments cannot stop borrowing, if central banks cannot normalize policy without breaking something, if households keep losing purchasing power, and if investors keep questioning paper promises, then hard assets become more interesting. Not because they are magic, because they do not rely on the same promise structure. A share of stock is a claim on a business. A bond is a claim on future payment. A currency is a claim on trust. Gold and silver are different. They are not someone else's liability. That is why they matter. And this is where the story gets uncomfortable for people who only watch headlines. They think silver needs one dramatic event to move. But maybe the real driver is not one event. Maybe it is the slow accumulation of pressure from debt, inflation, policy mistakes, energy risk, and currency debasement. One crack may not break the dam, but crack after crack after crack changes the structure. So, should you root for a financial collapse? Absolutely not. You do not want broken markets. You do not want frozen banks. You do not want emergency rules, capital controls, forced liquidations, or government interventions. Anyone cheering for the system to completely break has not thought through what that would actually feel like in real life. The better outcome is repricing, not chaos. Gold and silver do not need the world to end. They need the market to recognize that the currency has been weakened, that debt has consequences, and that central banks are not as powerful as people once believed. That is the real thesis. So when you see stocks rising, do not automatically assume everything is fine. When you see gold pause, do not automatically assume the thesis failed. When you see silver frustrate everyone, do not automatically assume nothing is happening. Ask better questions. Is liquidity driving asset prices? Are households actually improving or just paying more for essentials? Are bond yields pricing real inflation risk? Are central banks free to act or trapped by the debt system they helped create? And if confidence keeps leaking out of paper promises, what assets benefit when people finally notice? That is the part I want you to think about. And I want you to answer this in the comments. Do you believe silver is still being ignored by the mainstream? Or do you think the market already sees what is coming? Also, if you have built real financial discipline, whether through metals, investing, saving, or cutting debt, share one lesson that helped you. Somebody reading your comment may need exactly that push. Putting it all together, the market is not giving a clean, all-clear signal. It is giving a mixed signal. Asset prices may be rising because money is losing value. Inflation may be cooling on paper while still hurting real households. Gold may look slow until it suddenly is not. Silver may look frustrating until the setup becomes impossible to ignore. Sovereign debt may look calm until yields decide otherwise. And central banks may look powerful until the next shock proves how limited their choices really are. So no, the story is not simply that everything is collapsing tomorrow. The story is that the system is becoming more fragile while most people are being trained to stare at the wrong indicators. And if you understand that before the crowd does, you do not need panic. You need patience, discipline, and a clear plan. Thank you for watching. I will see you in the next video.